I'm the Tax Geek, and here are more of your taxes oversimplified. In this video, we're going to take a look at health savings accounts and how they work. A health savings account, or HSA, is a tax-deferred arrangement that allows you or your employer to contribute to an account that you can use to pay for qualifying medical expenses. As healthcare and health insurance costs have risen in recent years, more companies are looking to health savings accounts to reduce their health insurance costs. To qualify for a health savings account, you must be enrolled in a high-deductible health plan and not be enrolled in Medicare. What is a high-deductible health plan? First, it must have a minimum deductible of $1,400 for an individual and $2,800 for a family, and a maximum annual out-of-pocket expense of $7,000 for an individual and $14,000 for a family. Second, all expenses must be subject to the deductible, except for a defined list of preventative care services which can be covered with no deductible. A high-deductible health plan cannot have fixed copays for doctors, specialists, or urgent care. Let's look at these two marketplace plans and see why one is eligible for an HSA and one isn't. Both plans have deductibles that exceed the minimum of $1,400, but the HSA eligible plan has an out-of-pocket maximum that is less than $7,000. The non-HSA eligible plan exceeds the out-of-pocket maximum by quite a bit. With the HSA eligible plan, all services are subject to the deductible, whereas the non-HSA eligible plan has fixed copays for certain services. You can obtain a high-deductible health plan in one of two ways, either through your employer or you can purchase one through the federal or state insurance marketplaces. If you have a plan through your employer, you can make contributions to your account via pre-tax contributions, much like you would make into a 401k plan. Your employer can make contributions to your account on your behalf as well. These contributions are also tax-free. Contributions you and your employer make to your HSA are noted in Box 12 of your W-2 with a code W. If you have an individual insurance plan that qualifies you for an HSA, you make contributions directly to an account that you would set up at a bank or other financial institution. You would then take these contributions as an adjustment to your income on Part 2 of Schedule 1. In either case, contributions, up to the limits, are not subject to federal income taxes and are not subject to Social Security and Medicare taxes if you make them through an employer. And what are those limits? For 2021, you and your employer may contribute a total of $3,600 a year for an individual plan and $7,200 a year for a family plan. If you, or your spouse in the case of a family plan, are age 55 or over, you are allowed to make an additional catch-up contribution of up to $1,000. You can withdraw money from your HSA at any time to pay for any qualifying medical expenses. IRS Publication 502 contains a listing of expenses that qualify. In addition, you may use funds from your HSA to pay for over-the-counter medications and menstrual products. If you use your HSA funds in this manner, it is essential that you have separate transactions for these products. If qualifying items are commingled with non-qualifying items, the IRS will consider the entire transaction to be non-qualifying. And what happens if you use your HSA for non-qualifying expenses? You will have to pay income tax on the distribution plus a 20% penalty. HSA providers offer a variety of ways to withdraw the funds. Most providers provide a debit card you can use for eligible expenses. This card can be used directly at a point of payment such as a doctor's office or pharmacy, or online to pay a bill. If you incur an eligible expense and you pay for it with non-HSA funds, all providers will allow you to submit the receipt or bill and get reimbursement. If you have an HSA and either you or your employer made contributions, or you made withdrawals from the account, you must file Form 8889 with your tax return. The first part of the form reports your contributions and makes sure you did not exceed the maximum amount you can contribute. Any excess contributions are subject to income tax and a 6% excise tax. This tax will be assessed every year until the excess contributions are withdrawn. If you find yourself in this situation, you can withdraw the contributions plus any associated earnings by the due date of the return and avoid the 6% excise tax. The second part of the form shows your withdrawals and certifies that the withdrawals were used for qualifying expenses. If you have an HSA, you will receive a Form 1099-SA, which shows the total amount of distributions from the account. This is placed on line 14A of the 8889 form, and the amount of qualifying medical expenses, which should be the same, on line 15. And the best thing about HSAs is that the money in them is yours to keep. Even if you no longer have a high-deductible health plan, you can still make withdrawals from the account and it will continue to accumulate earnings. You just will not be able to contribute to it. This video only scratches the surface when it comes to HSAs. You will find links to additional information and resources in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. You can direct any questions, comments, or suggestions to the comment space below. If you prefer, you can email me at taxesoversimplified@gmail.com or follow me on Twitter at TaxGeekUSA. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.